We're jumping straight into FIGR today. Everyone is watching the price action, but the real story is their massive blockchain native lending empire.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get into the numbers, make sure you subscribe and hit the like button so you don't miss out on these breakdowns.
So, looking at the situation right now, it's a completely fascinating landscape. We are exploring a space where the old guard of Wall Street is colliding head-on with the frontier of decentralization.
Yeah, and it's happening a lot faster than most people realize.
Definitely.
Our mission today is to figure out how this company has quietly built this massive empire right under the noses of traditional banks. But to really set the stage for you listening, we have to talk about a glaring contradiction in their current market position.
Right. It's a classic market paradox. I mean, FIGR is boasting this staggering revenue acceleration.
Absolutely staggering.
And they hold an estimated 75% market share in a highly futuristic, fast-growing tech sector. And yet, if you look at the recent market action, specifically around late February 2026, you see their stock dipping after a mixed Q4 report.
Right, exactly.
Yeah.
So how does a company dominate an entire emerging industry, print massive revenue growth, and still face these significant market jitters?
It is the ultimate puzzle.
It really is.
Yeah.
So let's start with the fundamentals, the growth and the numbers, because the revenue acceleration here is really something to see.
Let's hear it.
They reported $339 million in adjusted net revenue for the full year of 2024.
Which is huge on its own.
Right, but then they hit approximately $190.5 million just in the first half of 2025 alone. That is a massive shift in momentum.
It certainly is. And it's not just top-line revenue growth,
Yeah.
which can sometimes be a mirage if a company is just burning cash unsustainably to acquire customers.
Right, buying growth.
Exactly. What's compelling here is their profitability pivot. They went from $20 million in net income for all of 2024
Okay.
to $29 million in just the first half of 2025.
Wow.
So you're seeing a company that is figuring out how to scale its profits significantly faster than its operating costs.
And the adjusted EBITDA numbers back that up completely. They hit $101 million in 2024 and then pulled in $83 million in the first half of 2025.
That shows incredible operational leverage.
It really does.
Yeah.
Now, for those who might not know the exact mechanics, we all know how painful traditional home equity line of credit, or HQC origination, is.
Oh, it's the worst.
It usually involves weeks of paperwork, right? Dealing with local county clerks, waiting in a queue, faxing documents. FIGR has streamlined that entirely. They're moving traditional borrowing into the digital age at a massive scale.
We are talking about originating between $17 and $21 billion in cumulative loans to date.
Up to $21 billion. That's no small feat.
And that scale is exactly what is driving these EBITDA margins. When you digitize a process that used to require armies of underwriters and loan officers, every new loan you process drops almost entirely to the bottom line.
Right. That's the beauty of software margins being applied to traditional lending.
Exactly.
But wait, let's pause for a second and look at the balance sheet, because there is a very surprising contrast here. As of June 2025, FIGR had a robust shareholder equity of $404 million.
Very healthy.
But right alongside that, there is an accumulated deficit of $292 million.
Right.
Now, a nearly $300 million deficit is hard to swallow for a lot of people. In today's market, investors are punishing tech companies that burn cash. How is this any different from, say, the fintech bubble of 2021, where companies just incinerated capital with no clear path to sustainability?
That is exactly the question skeptical investors are asking, and it's a completely fair one, but context is everything here.
Okay, unpack that.
An accumulated deficit isn't inherently a red flag if you understand where that capital is going. In this case, this isn't a situation where they're spending $300 million on Super Bowl ads or unsustainable marketing gimmicks.
Right, no stadium naming rights here.
Exactly. It is a very deliberate, calculated reinvestment strategy into their core infrastructure.
So you're saying they're actively choosing to run this deficit?
Precisely. Think about a traditional mature company that makes a profit. They usually pay out dividends to shareholders, or they buy back their own stock to artificially boost the share price.
Sure.
FIGR is doing neither. The free cash flow generation, which comes from their recurring technology licensing fees and the sheer volume of their marketplace, is being funneled right back into ecosystem growth.
Into the tech itself.
Right. Specifically, they are reinvesting heavily into decentralized finance protocols like democratized prime. They are betting that building out this massive blockchain infrastructure right now will yield exponentially higher returns in the future than a simple stock buyback would today.
I see. So they're essentially building the roads and bridges for the future of finance, and they're funding it with the cash they make from their core lending business.
That's a great way to put it.
But if they are building these roads, it begs the million-dollar question. What stops legacy banks or even massive fintech competitors from just looking at FIGR's success, copying the software, and stealing their lunch?
That is the critical question for any observer in this space. If the technology is easily replicable, your moat is zero.
Right.
But the answer lies in what we call a blockchain-native infrastructure. FIGR's secret weapon isn't just a slick user interface sitting on top of a legacy banking database.
It's not just a nice app.
No, it's the Provenance Blockchain. They handle end-to-end loan origination, the trading of those loans, and even lien perfection entirely on-chain.
And we really should highlight how big of a deal that is. Lien perfection in the legacy system involves physically recording a legal claim against a property with a local government.
It's totally archaic.
It requires manual labor. It takes weeks. Sometimes documents get lost. FIGR does it digitally on the blockchain in a fraction of the time. And they've built some highly specific proprietary tools to make this entire ecosystem hum.
Right, there's FIGR Connect, which serves as their marketplace.
And DART, which handles on-chain custody.
And then there is their yield-bearing stablecoin. Let's unpack DART and that stablecoin for a moment, because this is where the moat becomes nearly impenetrable.
Let's do it.
DART handling on-chain custody means the actual financial assets are securely held and verified digitally. This dramatically reduces their reliance on traditional, expensive debt facilities because the assets themselves are immediately provable to any potential buyer.
The transparency is built in.
Exactly. And the stablecoin acts as the settlement layer.
Right. And because they settle these transactions using that stablecoin, which is fully SEC registered, they bypass the regulatory nightmare that a lot of offshore crypto companies are currently facing.
Which is a huge distinction.
They are doing this entirely within the bounds of U.S. securities law.
Exactly. And when you combine FIGR Connect, DART, and that registered stablecoin, you create massive switching costs. FIGR isn't operating in a vacuum. They have a vast partner network.
Right. I saw they currently have 168 active partners and over 200 partners overall.
And when a partner integrates with FIGR Connect to access loans, starts using DART for custody, and settles their transactions in the stablecoin, they are deeply embedded in FIGR's ecosystem.
The roots go deep. And because FIGR has originated up to $21 billion in loans, there is massive liquidity locked into this network.
Which creates a powerful network effect. The liquidity providers and the borrowers are all anchored to the Provenance blockchain. You can't just unplug from that and move to a competitor without massive disruption to your own business operations.
It's too sticky.
Exactly. The more partners that join, the more liquidity there is, making the network even more valuable and even harder to leave.
It feels a bit like looking at Amazon Web Services back in 2010. While everyone else is fighting over the consumer-facing app, FIGR is quietly laying down the pipes and the toll roads that everyone else will eventually have to pay to use.
That's a perfect analogy.
Which leads to the most fascinating statistic we've seen looking at all this.
Right.
FIGR controls an estimated 75% market share of tokenized real-world assets, or RWAs, on public blockchains.
That 75% market share is the absolute crown jewel of their valuation thesis. We need to contextualize why dominating tokenized real-world assets is such a massive multi-year tailwind for them.
Right, because for anyone new to this, tokenization is simply taking a physical or traditional financial asset and creating a digital representation of it on a blockchain.
Right. So instead of a clunky paper contract for a $50,000 home renovation loan that just sits in a bank's filing cabinet somewhere,
Gathering dust.
it becomes a digital token.
Yeah.
It makes these historically illiquid assets instantly tradable, divisible, and vastly cheaper to manage.
You can fractionalize a loan.
Right. Yes. You can fractionalize it, sell it to multiple buyers globally in seconds, and have the interest payments automatically distributed via smart contracts. No middlemen required.
And the fact that FIGR processes 75% of this volume on public blockchains means they are effectively the toll booth for the future of asset trading. Legacy competitors simply cannot match that scale or infrastructure overnight.
They can't. It would take years and billions of dollars to catch up.
But let's pause for a second. If they practically own the infrastructure for tokenized lending, and they have this impenetrable moat with 200 partners, why did the stock take a hit after the Q4 earnings? Wall Street clearly has some reservations.
They do.
On February 27, 2026, the stock dipped following mixed Q4 results. We have to look at the bear case here to keep this balanced.
It's important we impartially outline this bear case because no company operates without friction. The primary immediate risk is the threat of prolonged consolidation. When a stock dips on mixed results, even if the underlying business is growing year over year, it can enter a psychological holding pattern.
And in a high interest rate environment, investors are particularly unforgiving. Capital has options right now.
Exactly. If FIGR's future guidance in the coming quarters disappoints, or if they just trade sideways for 6 months, investors might lose patience and move their money to safer yields. The market is digesting those earnings, and there is a very real risk that the stock struggles to break out of its current range if the revenue acceleration doesn't maintain that breakneck pace we saw in H1.
Makes sense.
Furthermore, there are broader macroeconomic risks that are entirely outside of FIGR's control. Around March 2nd, 2026, we saw geopolitical volatility spiking, specifically the tensions in the Middle East.
Right, we've been seeing that all over the news feeds.
And geopolitical tensions historically cause capital to flee from perceived risk assets. Despite FIGR's solid, traditional lending business, their heavy reliance on blockchain technology categorizes them as a riskier tech play in the eyes of many traditional institutional investors.
Not to mention the ever-present shadow of crypto regulation. The broader crypto and blockchain space is notoriously volatile when it comes to government oversight. Sweeping changes to how digital assets are classified could theoretically disrupt their Provenance Blockchain operations.
That is the fear, certainly. But this is where the nuances of their business model provide a serious counterweight.
Right, which goes back to what we discussed earlier. FIGR is highly focused on the U.S. market, and their stablecoin is SEC registered. That distinction makes their regulatory risks far more manageable compared to the offshore crypto companies.
They aren't trying to evade regulators. They are actively building within the U.S. regulatory framework.
Which is exactly why the regulatory environment might actually end up being a strength rather than a weakness for them.
I agree completely. And that brings us to how the institutional investors are reacting to this mixed Q4 data. There is a very interesting divergence right now between retail sentiment and institutional behavior.
Yes. Let's look at what the whales are doing. We haven't seen the big institutional players tip their hands in their quarterly filings just yet, but the sheer volume of trades and the market flow data from early March suggest that massive institutional players might be quietly accumulating FIGR stock right beneath the surface of this post-earnings volatility.
It's a classic market dynamic.
Really? How so?
Well, retail investors might panic sell on a mixed Q4 headline, while institutional whales use that added liquidity to quietly build a massive position at a discount. They are looking past the current quarter and focusing on that 75% market share in tokenized assets.
That makes a lot of sense. And if you look at how financial analysts are defending FIGR, it strongly supports this exact theory.
The analyst actions are incredibly revealing here.
They really are. Analysts across the board, from Goldman Sachs to Keefe, Bruyette, and Woods to Needham, they all trimmed their short-term price targets. They brought them down from the 60s and 70s into the mid-50s and mid-40s.
Right.
But crucially, out of the 6 analysts recently covering the stock, they refused to drop their underlying positive outlooks. Goldman maintained their positive stance, Keefe kept their top-tier conviction, and Needham held firm on their bullish rating.
This is a vital distinction for investors to understand. A price target cut combined with a maintained top-tier rating usually means one thing.
What's that?
The analysts are just adjusting their mathematical models based on broader market multiples or slight short-term macroeconomic headwinds. But their fundamental conviction in the company's long-term business model hasn't wavered an inch.
They still believe in the core engine.
Exactly. They see the nearly $190 million in a half-year revenue. They understand the stickiness of the Provenance blockchain, and they are essentially saying the long-term thesis remains fully intact.
So, the consensus among the so-called smart money seems to view this recent post-earnings dip as mere noise. They are focusing entirely on the underlying growth of the blockchain infrastructure.
Absolutely.
But for you listening, you are probably wondering what actually happens next. Let's look ahead and outline the timeline for the next 90 days. What are the specific events that could move the needle here?
The most immediate trigger to watch will be the Q1 2026 earnings. Those should be expected in late April or early May. This is going to be the ultimate proving ground for FIGR.
Right.
The market will be laser focused on one specific metric: is the massive revenue momentum we saw in the first half of 2025 continuing into the beginning of 2026. If they beat expectations there and show that the core lending engine is still accelerating, the next results of Q4 will be entirely forgotten.
You also have to watch for potential updates regarding FIGR Connect and their DeFi integrations. Any new partnerships announced for Democratized Prime could signal that their reinvestment strategy is finally paying off. But beyond company-specific news, there are massive macro tailwinds that you need to keep an eye on over the next 3 months.
The U.S. interest rate environment remained the massive factor. Because FIGR originates home equity lines of credit, their core business is deeply tied to lending rates and the broader housing market.
If rates stabilize or drop, home equity borrowing becomes much more attractive, which directly feeds their top line.
Exactly. But perhaps even more uniquely, there is a fascinating macro narrative developing around global crypto regulation right now.
Yeah, there was a significant narrative emerging around March 4th, 2026, highlighting the United States' ability to attract capital over the European Union, specifically due to regulatory frameworks.
Right.
Because the EU is implementing stricter, more convoluted rules for digital assets, institutional capital is flowing to the U.S. looking for clarity.
And because FIGR is a U.S.-based, SEC-compliant blockchain ecosystem, they disproportionately benefit from that global capital rotation.
The regulatory risk we discussed during the bear case actually flips into a major catalyst.
It does.
Mhm.
If global capital wants exposure to the efficiency of tokenized assets, but demands the safety and legal clarity of U.S. jurisdiction, FIGR's Provenance Blockchain and their registered stablecoin become the most attractive destination on the market.
Okay, let's bring this all home. Why should you, the listener, care about FIGR? You should care because this company is the definitive proof that terms like blockchain, tokenization, and DeFi are no longer just buzzwords used by speculators trading internet coins.
Not anymore.
They are actively, right now, being used to process billions of dollars in boring, everyday financial products, like a home equity loan for a family renovating their kitchen. And in doing so, FIGR is crushing legacy competitors with faster, cheaper, and fundamentally more efficient technology.
If I were to synthesize the ultimate takeaway from everything we've looked at today, is this: FIGR represents an undervalued infrastructure play with immense multi-year compounding potential.
I couldn't agree more.
The mixed Q4 earnings reaction is short-term noise masking a long-term signal. Their fundamental growth is being driven by the inevitable global adoption of tokenized real-world assets, a space where they currently hold a dominating 75% market share.
It is a classic case of an innovative moat scaling up while the broader market is momentarily distracted by quarterly headlines.
Exactly.
It really is an incredible story of innovation hiding in plain sight. As we wrap up today, we want to leave you with a final provocative thought to mull over on your own. We've talked a lot about FIGR's growth and their technological moat, but think about the other side of the equation.
The legacy side.
Right. If a single tech company can capture 75% of the tokenized real-world asset market just by building a faster blockchain-native pipeline for traditional loans, what happens to the legacy banking system in the next decade?
It's a great question.
Will those massive traditional banks be able to adapt, overhaul their archaic databases, and build their own blockchains? Or will they inevitably become just another client, paying licensing fees to use the technology they once completely ignored?
That is the multi-trillion-dollar question for the next decade of finance.
It really is. Thank you so much for joining us today. We hope this exploration has helped you feel more well-informed about the collision of traditional lending and blockchain technology. Keep questioning, keep exploring, and most importantly, keep learning. Until next time.